Hey, what's going on, everybody? Today we're going to talk about credit. So, we're going to talk about what a good credit report is. We're going to talk about credit scoring, and we're going to talk about how having a negative credit score could affect your chances of getting a mortgage, a car loan, a personal loan, anything you're trying to do to get ahead and succeed. So, yeah, we're going to get into it. It's not going to be a long video, a real quick video, just giving you a basic of credit. So, credit is something that you could use to obtain things like a house, a car, a loan, things that you need in your everyday life. So, now when you're dealing with the credit bureaus, they deal with credit scoring. So, the credit scoring is a system where credit is used to help determine whether they're going to give you credit and how much they're going to charge you for it as an interest. So when you apply for credit, the creditor or the lender will request a report from one of the three big credit bureaus, which is Equifax, Experian, and TransUnion. So like when you're applying for a mortgage, when you're applying for a car, when you're applying for a personal loan, the creditor is going to say, okay, let me take a look at your credit report and see what your scores are. And that's how they're going to determine, are you worthy of me lending you money? And if they do lend you the money, how much are they going to put in interest that they want back? Now, your credit worthiness, it comes from calculating the credit history against a system called the Fair-Isaac model. Now, the Fair-Isaac model uses a variety of factors to determine your score. It could come from your bill paying history. Are you paying your bills on time? No late payments. The number and type of accounts that you have. So, the more accounts that you have are better. It looks better. It looks like people are lending you credit. So if you only have about three companies reporting to your credit, then that could have a negative impact on your score also. The more companies reporting on your credit report, the better. But you want to have them, like I said, in good standing. They want to make sure you have no late payments, no collections, no outstanding debt, and the age of your credit history is important also. So you want to that in a later one. We'll talk about how you could boost up your age and credit. So the credit cards that you want to have them with like 10 years and better. The higher the age of the credit, the better it is. So now when you're dealing with your credit, the stuff that affects your credit score is payment history is 35% of your credit report. So you don't want to get no late payments on your credit report because that's 35% of your credit report. Now, the amount of money that you owe on each credit card or mortgage or loan or whatever it is 30% of your credit report and goes along with your credit limits. So now, if you have a credit card with a $500 credit limit and you're using, let's say, $400 out of the 500, that's going to drop your score. But now, if your credit limit is $5,000 and you're using $400, then you're still good. So what you could do is you want to try to get a credit line increase if you know that you're going to have to use that card, or just make sure you're using less than 30% of your credit. Now, the length of credit is 15% of your credit score. So that's why I was saying before, you want to make sure you have 5 years, 10 years, 15 years, 20-year credit. Don't close none of your credit cards. If you don't want to, just don't use them. If you don't want the card and you don't need to use it, just don't use it. But don't close the account. Keep it open. Now, new credit is 10% of your credit report. So new credit is 10% of your credit report. So that includes the number of inquiries, like if you're going for a loan, if you're going for a car, if you're going whatever you're going for, it's going to show up as an inquiry. Now, every time a new account is open and inquiries are open, that amounts to 10% of your credit score. And then the types of credit that you have is also 10%. So it depends on what kind of loans you're going for. Installment loans, credit cards, mortgage, car, all the regular stuff. So that's 10% of your credit. And now credit ranges anywhere from the low 300 is the lowest you could have, or 850 is the highest you could have. So basically now, if you have a low credit score, the interest is going to be higher on the loan that you're getting. Any loan that you're going for, if you have a low credit score, if you have a 550 or a 600, you're going to get a high interest rate. Now, if you above a 700, now you're going to get a lower interest rate. So yeah, these are some of the simple things right now when you're dealing with credit, what you want to look for, and just make sure you try to build up your credit from now, because it's going to cost you in the long run with the interest. So the lower credit score that you have, the higher interest you're going to pay. The higher credit score you have, the lower your interest is going to be. And with that one, I'd like to say thank you for watching. If you appreciate the information, like, subscribe. You can share this, and I'll definitely come back with some more. Thank you.